Have you ever wondered how economies bounce back from a slump, or what hidden forces might sometimes make things worse? It is a complex dance between markets, human behavior, and the powerful levers pulled by central institutions. Understanding these historical interactions is key to appreciating our financial present. Monetary policy has significantly affected past recessions by influencing their severity, duration, and even onset. Historically, central bank actions or inactions have played a pivotal role, sometimes exacerbating economic downturns and at other times providing crucial stabilization. The core mechanism involves the central bank's control over the money supply and credit conditions. During recessions, central banks typically lower interest rates to encourage borrowing and spending, injecting liquidity into the financial system. This aims to stimulate aggregate demand. Conversely, tight monetary policy, characterized by high interest rates and reduced money supply, can sometimes trigger or deepen a recession, often in an effort to combat inflation. Before the modern era, central banks often operated under constraints like the gold standard, which limited their flexibility to expand the money supply during downturns, as seen during the Great Depression. The shift towards discretionary monetary policy, heavily influenced by Keynesian economics and later monetarism, allowed central banks more freedom to actively intervene. For instance, the Federal Reserve's delayed and insufficient response to banking panics in the 1930s is widely considered to have worsened the economic collapse. In contrast, coordinated interest rate cuts by central banks during more recent global financial crises demonstrate a more active and expansionary approach to mitigate severe economic contractions. To analyze the impact of past monetary policy, historians and economists examine changes in key indicators such as interest rates, the money supply, and inflation alongside real economic variables like gross domestic product and unemployment. They assess how central bank decisions, such as open market operations, reserve requirements, or changes to the discount rate, correlated with subsequent economic performance. Understanding the counterfactual, meaning what would have happened without the policy intervention, is a critical but challenging aspect of this historical evaluation. Researchers use econometric models to disentangle the effects of monetary policy from other contemporaneous economic shocks, helping to build a more accurate picture of its influence. A key insight from studying past recessions is the concept of the zero lower bound, a situation where nominal interest rates cannot be cut below zero. This constraint gained prominence after the 2008 financial crisis, highlighting the limits of conventional monetary tools. Another crucial factor is the evolution of central bank communication, often referred to as forward guidance. This practice involves central banks publicly announcing their future policy intentions, aiming to manage market expectations and enhance the effectiveness of their actions, a stark contrast to the more opaque operations of early central banks. Ultimately, the historical record of monetary policy during recessions reveals a continuous learning process for central bankers and economists. From the rigid adherence to commodity standards to the flexible, proactive interventions of today, each downturn has provided invaluable lessons. The interplay between theoretical understanding and practical application has continuously refined the tools and strategies used to foster economic stability, aiming to reduce the pain and duration of future downturns.